knowing your numbers is the single biggest thing that we could reinforce as a business owner, in my opinion. It all ties in hand. You have to have good painters to make money, obviously, but if you don't know where your numbers are at, you'll never be a profitable business. So let's get things underway here. So a little bit about myself. You guys get to hear it again. Sorry, it's been a kind of a small group, so we went over things several times. We started our business in 2012 in Seattle, Washington. We moved there kind of at the right time. My background is I'm a third-generation painting contractor. I've kind of wore all the hats. I started painting at 15 years old. My dad would take me to job sites as a kid. For the third, fourth, fifth generation painters here, second, that's kind of the life we grow up in. You know, I never really had a daycare. Through the process, I was an estimator. I opened my first business when I was 20, completely failed it. That was very much a learning experience as far as didn't know what I was doing with accounting. When I was 19, I was diagnosed with ulcerative colitis. They removed my colon when I was 21. So there was a whole 3 or 4 year period I battled that. It's very similar to Crohn's disease. So that slowed me down a little bit, to be honest. A little bit about Lindsay. She's a 2016 graduate from the University of Washington. Throughout that time, she worked with our business, kind of doing the books and keeping me in check as far as getting rid of all my bad habits from my other business, straightening out the books, not paying anything in cash, which you should not be. To all the old school people, that's the world that I grew up in. My dad was cash overtime. A little bit about our business. We did $110,000 in revenue our first year in 2013. We went into business 2012, but in 2013 we did $110,000 in revenue. This year we'll do 1.9 to 2 million. Strong growth, but not in our market. It's not too bad. We add a crew every year, so we grow about 400,000 or 500,000 a year. We own some investment properties. We have a triplex and a couple other multifamily properties. In Seattle, it's very hard to find property just because things don't cash flow and it's very expensive, so we might have to start looking outside. But that's kind of our side business, and we funnel money from the business to real estate because ideally people don't want to paint forever. I sure don't. I mean, we love it, but I'm just saying, I mean, if you want to be painting at 70, that's fine. A little bit about our business. Everyone's business is unique to them. You know, everyone's business is different. The type of work we do is 80% residential, 20% commercial. It's very normal for residential light commercial business. Our target market is high-end clientele. We have Amazon, Microsoft, T-Mobile, Costco. The list goes on and on and on for Fortune 500 companies in Seattle. Boeing's the largest employer in the state, so there's a lot of money to spend. So that gives us, you know, good clientele who have money, you know, disposable income. How you said your model, you have the designers. We don't work with a lot of designers. We go after kind of that niche market because that's where the money's at. The size of our business, we have 21 employees, 16 painters, 1 part-time project manager / painter. We have a full-time carpenter, Lindsay and myself. We have a full-time sales rep, and we have a admin who answers phones. If you can get to that point, it's well worth the money for 25 hours a week to pay someone to respond to inquiries. Phones, it's very important. Our tax structure, we're an LLC S Corp, which is a pass-through entity. As far as your tax structure, talk to your accountant, figure out what works best for you. It's what works best for us. We do get a salary, which if you're running a legit business, you should be taking somewhat of a salary. They say, what is it, a livable, I don't know. Reasonable for your job. So if you're taking $20,000 a year, maybe you can justify it. Talk to your accountant. We're not accountants. Our vision, I'd like to grow our company to $10 million per year. There's going to be a lot of hurdles to get there, but that's where I'd like to be. You know, we have good people behind us, so I think with the right hustle and the right people, we can do it. Our reputation in the community, we've been in business for 6 years. We've built a pretty strong reputation. We're well respected in the community for 6 years. We're involved a lot in community involvement. We donate painters for a day, which is 8 hours of labor. We donate to charity auctions. Basically anything that we can get our name out. Seattle's a very large market, so it's very difficult to dominate the whole city. So we pick our area of West Seattle. It's like, if you're in New York, it'd be a borough. It's very difficult to dominate the whole city. So it's a little bit about our community involvement. Let's talk about the agenda a little bit. We're going to go over what chart of accounts are. Cash versus accrual accounting, it's very important to understand that. Which one is best or best practices. We're going to go over P&L, profit and loss statement. We're going to talk about industry averages. These are just averages that we've kind of compiled. Everyone's business is different depending upon if you do new construction, your materials might be a little bit higher. We're going to go over statements of cash flows. We're We're going to talk about marketing return on investment. So that's a really key thing that Nick talks about a lot is ROI. What does that mean? How do you calculate that? We're going to talk about some other metrics. We're going to do a final conclusion, and we're going to go over the question and answer session. All right, now I'm going to pass it off to Lindsay here to talk about chart of accounts.
All right. So the first thing we want to talk about is the chart of accounts. I think this is going to be most helpful to those of you that are kind of just starting out with your books or maybe wishing to improve your books. I kind of find that we revamp this as our business evolves and changes. So the reason we want to talk about chart of accounts first is it's really the foundation for all of your financial statements and all of your accounting process. So what the chart of accounts actually is, it's all of the different categories that your business transactions fall into. So in this session, we're really focusing on your profit and loss statement, also known as income statement. So we're going to talk about mostly those income and expense categories. But I do actually have a handout, and you guys can laugh at Nick because he didn't know where the paper was. So we've got this on letterhead, and it's a little funky, but I promise you can read it.
It's our old letterhead that I found stashed somewhere. So.
But you can read it, and that'll actually include not just the income and expenses, but all of the other categories. So your current assets, long-term assets, current liabilities, long-term liabilities, and your equity. But we're going to focus on, in the actual session, a little more on the income and expense categories. And we can talk about that more at the end if you guys have questions about any of the accounts on there. So as far as your chart of accounts, what?
Can you just be a little bit louder?
Oh, yeah, I'm sorry. So as far as your chart of accounts, this is really going to vary by your business. Every business is a little bit different. Depending on what activity you're doing, you might want to track different things. And it kind of depends on what information you want to get out of your financial statements. So, it can be as broad or specific as you want to track. That being said, it should be specific enough that you can prep a tax return based on the information, of course, and so that it's informative for you, so that you're getting valuable information from it. So as far as getting really specific, you can have sub-accounts within your accounts. So for example, if I have like a marketing expense account, maybe I want to track what I spent on online marketing versus print marketing or other types of marketing. So that's one example of how you can get as specific as you like, but I would caution you not to make it too cumbersome. Now, as far as types of accounts for your profit and loss, you have your income. So that's, of course, your top line revenue. So when somebody talks about, I'm a $3 million painting company, that's what they're talking about, is that top line revenue. There is your cost of goods sold, which we're going to highlight a little bit more, but that's all of the direct expenses that go into producing your revenue. So labor and materials are the big ones we think about. There's also operating expenses, so everything we think of as overhead, so your administrative, payroll, marketing, everything that doesn't go into cost of goods sold. And then finally, there's other income and expense. Might not see this on every statement, but that's going to be anything that's peripheral to your business. So some examples of that would be interest income, rental income, things like that. So I want to highlight the cost of goods sold because every business owner kind of does see this a little bit differently. It does depend on your business, and that's okay. So again, cost of goods sold is direct costs attributable to your services sold. And again, there's some gray area here. So one example of where some business owners see this differently is commissions. Some people feel really strongly that your commissions should be in your cost of goods sold. Others will put it into the operating expenses or the selling general and administrative expenses. So that's just kind of an example of how this can be different. There is some gray area here. And actually the P&L sample that we're going to hand out is going to be a bit different from that chart of accounts, just so you guys can kind of see a different way to lay things out and just get two examples of that. That being said, at a minimum, there are certain things that you definitely want to include in your cost of goods sold. you want to include, of course, your direct labor. So all of your gross wages attributable to your painters out in the field, that's going to be included in cost of goods sold. Your materials expenses, so of course your paint, along with sundries, supplies, small tools, equipment. Exception would be larger equipment purchases, which will actually hit your balance sheet as an asset. But in general, you want to track everything that's going into the job. You also want payroll burden in there, so that's going to be employer taxes associated with the wages to your painters. That should also include workers' compensation. I know Washington's a little bit different, where it's more so a payroll tax, but I think that's appropriate to include in cost of goods sold. And then you also want to include your liability insurance. I think that kind of varies state to state too, but generally you can't do a job without that. Now we're going to talk about cash versus accrual accounting. We're actually going to show on the sample P&L we have cash on one side, accrual on the other, so you can see the difference. So I'm not sure if anyone on the books is using cash basis of accounting. If you are, I'm here to tell you that you should not be, and we'll talk about why. So first, let's just talk about what the cash basis of accounting actually is. So on the cash basis, you're recording your revenue when your cash is received, and you're recording your expenses when your cash is dispersed. So what that means is, let's just say I'm doing a job this month, and it's a commercial account. I'm expecting to be paid in 60 days. So let's say I get paid and it's June. So I'm actually going to record my revenue in June, even though I did the work and actually earned that money in April. However, your expenses, you might find you're paying out right away. So I have expenses in April, I have revenue in June, but they're really associated to the same activity. So you can see how it's just a total mismatch, and it just gives you an inaccurate picture of your finances. So while the advantage of it is it's easy, there's no receivables, there's no payables, but the disadvantage is just too heavy. It's really not it's not reflecting your business activity and profitability in the period that you're looking at. So the advantage of accrual is that it does do this. It does match those expenses and income together, which in accounting we call that the matching principle, so that's really important. So what accrual does is you record your revenue when you earn it. So when you've actually done the job, you've completed the job, you're recording your revenue. So if you're on QuickBooks, which I would assume most people are, once you invoice that job, it's going to hit your profit and loss as revenue, regardless of when you get paid. As for your expenses, same thing. So if you have expenses that are on a billing cycle, it's going to hit once that bill comes in, regardless of when you pay it. So we did talk about the pros and cons of each. Really, the accrual basis is going to give you the best picture of your profitability according to the activity that you've done in whatever period you're looking at. The one disadvantage of accrual is, of course, it's not reflecting your cash flow. So you could have a great bottom line, but the cash flow might not be there. So it's very important to track that separately, and we'll talk about that in later slides. But now Jeff is going to go over the example we have of a profit and loss statement, and we actually have that on paper to pass out to you guys.
It's my favorite part, guys. It's how much money you're making. Let's get excited. This is the most important thing to know here. It's pretty much all I look at. No, I'm kidding. Nick, can I get one of those?
Sorry?
Can I get one?
You could open the link too.
I'll just take one. I'll lead it off the thing. Oh.
Yeah, sorry about that.
Yeah, I had to zoom in on my computer.
I could read it, but you might need a magnifying glass.
Oh, wow. Okay.
At least it's all on one page, right?
All right.
It's kind of like a blur.
Let's,
do you want to put it up here?
Yeah, why don't you actually, will you? Sorry, technical difficulties.
Clearly young presenters.
Yeah.
What?
Our age is showing right now. I'm sorry.
Yeah, exactly.
I was there 4 years ago.
Yeah.
Is that any better though, really? No, it's not. Okay.
There's a bigger one, right?
Yeah, I can zoom and you can just.
All right, we'll talk about it.
scroll.
Let's do it. All right, here's,
Oops, I'm pressing the wrong button.
I got it here. Scooch over with.
Okay. I'm just trying to get it all on the screen.
Remember, young presenters. No, I'm playing.
Okay, and that way you can scroll. You can.
All right, I got
I
it.
guess you
Thanks.
can do that.
All right, so let's dive in. So a P&L is not super difficult to read if you understand what the numbers mean. First thing, like Lindsay talked about, there's accrual versus cash basis. Let's run through the accrual basis. That basically means all the money that came in that month, that's what you accrued. So in this ABC painting, $175,000 they accrued. So that's the total amount of revenue they did in the month. That doesn't mean what they received. If you gross $100,000, that would be accrual basis. So let's dive into the numbers here. Sorry. Struggling to see this too. Okay, so the first section is total cost of goods sold. And what makes that up is you have direct labor, so that's the amount of labor that you paid out for your painters, which in this P&L it's 30%, which is pretty good. The next big thing you need to know is materials. How much you're doing in materials? 8%, that's really good. Every company tracks it differently. We personally do sundries and materials combined. Some firms will do sundries separate, so maybe you're running 8% materials and 3% sundries.
I think this one does.
Yeah, this one does it separately, I think. We run 10.5% last month, I think, total. But we track it as a whole together. But if your people are buying extra brushes or maybe stealing, extra things like tape or something like that, it might be good to track both. It really depends how much you want to dive into it. You can go as deep as you want into financials, or you can make it easy. I personally like to keep things simple so you know the round number and kind of know where you're at. But Lindsay really likes to dive in, and we pretty much know like everything in real time, like to the minute almost. But I'm just playing. You what?
She's an accountant.
Yeah, I know. Maybe I get like daily updates, but I get So as you scroll down here, these are all the other things that go into the cost of goods sold. You have processing fees, commission here, logistics, payroll taxes.
What is logistics payroll?
In this situation, this is just ABC. This is just a made-up chart.
So I would assume this profit and loss, they have someone that is moving stuff to and from the job sites. So I can see how that goes into cost of goods sold. It's an example of how that differs. Like for us, that really doesn't apply. So we don't have that on our financials. But
So they don't have it in cost of goods sold here.
Huh?
It's not in cost of goods sold here, but I would agree.
Oh, okay. Yeah, they have logistics, not logistics
Sure.
payroll. Okay.
Everyone is going to do their P&L a little bit differently, but yeah, I would put that in there. So let's scroll down here. So total cost of goods sold is the direct expenses to produce the income. So what those expenses are generally paint, direct labor, taxes, or not actually, yeah, taxes.
Payroll taxes.
Payroll taxes. So everything that would cost you to go out and paint the house, not as far as the operating expenses of running the business. So in this situation, the total cost of goods sold is 47%. What that leaves you is the rest of that leaves you your gross profit, which would be 53% here. And that's great. So 53%, so that'd be a 53% gross. Let's scroll on to the operating expenses here, operating. So you scroll down, you have administrative costs as far as what it costs you to operate the business. That would be the owner's salary, that would be admin. I mean, I can break out each thing. That would be auto expenses as far as van payments. That would be internet, basically anything that goes into operating the business. If you have a shop space, any of those expenses. And we can touch down upon this at the end if you guys have questions. So, sorry, I'm trying to be able to see this here.
This is always a good question of financials, and
Sure.
there's different strategies to it.
Definitely.
So I know there's annual fixed cost on automobile expenses.
Sure.
And then there's a variable expense on the transportation, right? How many vans and trucks you're running.
Sure.
So a lot of people say, well, it's a variable overhead. You can either put it in under
Sure.
overhead expenses, or you can put it in cost of goods sold. We
Sure.
tend to put everything in cost of goods sold because even
Sure.
the IRS doesn't need to know, but I'm driving my truck around 24/7 and writing the whole thing off. Right?
Sure, yeah.
But that all still falls under cost of goods sold in my company.
Sure.
Again, it doesn't.
Again, yeah. I mean,
Yeah.
how you do it is up to you. I think the biggest thing here is understanding what the numbers mean, because we put it into our operating expense.
Yeah, we do.
But everyone does it differently.
And I totally understand that. I think for us, it's just all of that downtime. We have some guys that take the trucks home. So it's, for us, I feel like it's more informative to have it down with the operating expenses. But again, I mean, that's a great example of how everybody wants to track things differently.
Our philosophy on it is anything that goes in cost of goods sold is something that you can specifically directly charge to a specific project.
Yeah.
So in automobiles, it's a nightmare to track individual mileage to an individual job, so we actually have it in overhead as opposed to.
Yeah.
I think it's business preference.
Yeah, I mean, people can debate all day long about the merits of putting this here or this there, but like you said, at the end of the day, you don't.
At the end of the day, your net is your net.
Yeah.
There you go. So let's get to my favorite number, guys. At the end of the day, understanding numbers. So the reason why it's so important to understand the numbers is to know where your stuff is going. So if materials are getting out of control, you need to understand what the percentages mean. You can easily pull these. You can go to QuickBooks. If you don't have up-to-date numbers, get a QuickBooks Pro Advisor, 3 hours a week. It's the best money you'll spend.
Is everybody on QuickBooks? I'm just curious if people use something different or if that's the standard. Yeah?
Okay. So
Yeah,
you go to
I agree.
QuickBooks, you pull a P&L, you go to the income chart. As long as you have real-time updated numbers, with all your expenses, you can go there and pull a P&L at any time. It's click, percentage.
Are you guys on QuickBooks Online or are you on desktop?
We're on online.
Yeah, it's easier for our accountant to do stuff. So
Yeah.
at the bottom here, you have net income. That is how much money you made, okay? If you're a $100,000 business and you netted 20%, that means you made $20,000. Ideally, if you're running a legit business, you should be taking a salary. Whatever that amount might be, you got to decide that. You know, again, everyone runs their businesses differently, but if you have $1 million company, and you take $50,000 or $50,000 a year salary, that'd be like $4,200 a month or something like that, or $4,400. Your net here is that's what's left after everything's said and done, after everything's paid out, and that's the number that matters the most. So here, 23% net, $41,000 in ABC painting. It's huge. It's a great profit. And yeah, I mean, it's killer money, you know. So let's scroll over here to what
Track depreciation. You guys typically track.
we do. Track depreciation. This is not our business. This is ABC
We
painting.
personally don't by the month.
Yeah, we do it.
We do it at the end of the
Yeah.
year. So our net profit looks way higher in our books. Like, let's just say
Yeah, and then
it's
the
10%,
last month it
and then the
goes.
last month, ours went down like 3%. Our
Yeah,
net's actually much higher than 10.
depreciation.
But yeah, it killed us at the end. It dropped 3%. We depreciated like 6 vehicles.
But that's also why. Yeah.
No,
exactly.
it's good.
Yeah.
But it just lowered our net
And
income
that's why
by
it's
like
important to
30,
know the
40
difference
grand.
too between the net operating income and the net income, because the depreciation goes into that other section.
And anyone who has questions at the end, Lindsay is like a guru here. You have any questions?
About that.
I'm just real quick.
Sure.
I'm wondering, because you have two different sales income numbers, and you get the same labor.
We're going to talk about that. So cash versus accrual basis.
Okay.
So here, let's scroll over to cash basis. What cash basis, like Lindsay said, what cash basis is the total money. So the other one, accrual, is how much total revenue came into the business. Cash basis is how much money was paid or how much money the business received. So even though they grossed on accrual $175,000, in cash basis, they only received $145,000. So the difference between accrual and cash basis is that's how much money was paid in receivable. Yes, go ahead.
Let's clarify for everyone here. Cash is how much money you receive in checks, cash, credit cards, whatever.
Yes.
That is how it is counted.
Exactly.
Accrual is counted.
Yes.
Yeah, and accrual, though, you could have a huge, you could have huge revenue with accrual, but maybe your cash receivables are very low. So maybe you accrued $200,000 over 2 months, and you've received $30,000 in cash. Well, you have $400,000 gross. You've only received $30,000. So your money, you don't have
And
much
that's
money.
where you get in trouble.
So do you typically watch both, or you set up one way?
We'll set up one way. You have to file with the IRS with one way or another.
Well, you can have
don't
your
you?
books however you want. Even if you file taxes on one or the other,
Okay.
you can track your books however you want. And QuickBooks, I mean, it's as simple as you pull this report and you click, do I want to look at it on cash? Do I want to look at it on accrual? So you can do that.
Balance sheet's all screwed up in QuickBooks when you go to cash, so
I personally,
I don't
accrual
look at
accrual is the way to go. And if you guys don't understand it,
Yeah.
hire.
That would be weird.
Yeah, QuickBooks Pro Advisor is like the best way to go.
Yeah, and even if that's just to get you set up, great investment. If you're trying to set stuff up in the beginning, sometimes that's where it can get the most messed up if you don't know what you're doing. So
So let's talk about cash basis. So basically, this is all the cash they received. As far as cost of goods sold, their labor, labor you have to pay out no matter what, or you won't have a business. So it's the same. The labor is the same. Materials is less. The rest is probably in receivables.
Payables.
Or payables, I'm sorry, for materials. We have all the same fees here because these are direct expenses that they have occurred for the cost of goods sold. Their cost of goods sold was 52%. Their gross profit was 48%, which is still really good, even on a cash basis. These are really good numbers. ABC Painting is killing it. You go down to operating expenses. These are all things they have to pay out as far as, office staff. You don't pay your administrator, they're not going to work there anymore. So on a cash basis, all these things you still are going to incur no matter what, unless your team wants to work for free, which I haven't found that yet. So you scroll down here, so it's all the same, and then you have a net income of 13%. And the reason that they're lower is this is the total cash that they received on an accrual basis. It's the amount of total revenue that was on the month. So does anyone have any questions about the P&L? We can talk about it more at the end, and Lindsay can probably explain it better than me. But knowing your numbers is the single biggest thing I'd recommend. Not understanding numbers when Lindsay and I got together, that's why I got in trouble with my first business. I didn't know what net profit was. I didn't know what gross profit was. I didn't understand what my materials were. So understanding these percentages is key, because imagine your materials, we're going to talk about this more later, but if your materials get out of control, if you don't know your percentages, if you do $1 million in revenue, but you have $1 million going out, you made no money. So I'm just breaking it down in simple terms. For bigger businesses here, it's going to be more advanced, or someone like JP who has a accounting degree, or Lindsay. But any painter can understand it. You can go to QuickBooks. As long as your numbers are updated in real time, or monthly, or whatever it might be, you can go to QuickBooks. Okay, quarterly's fine. You mean updating them? Yeah, you want someone updating them weekly,
yeah.
Or twice a day, maybe. So
as far as analyzing it, you might find it helpful to analyze the month.
You want them updated regularly, so that's because your QuickBooks Pro Advisor will kill you if you bring them all the receipts for a month. So yeah, weekly is probably the best thing to do, because it's a lot of entries. But as far as that, knowing your numbers is a huge key, because at the end of the month, if you had $100,000 come in and $100,000 went out, but you think you're making money, you're in trouble. And if you track your things on a monthly basis or quarterly basis, depending upon your size, or a weekly basis, the more you understand, the more you can forecast what you need to do to change your business to be profitable. Because at the end of the day, I don't care how big your business is, how little it is, it matters how much you make. You could work the same for $500,000 as you do for $1.5 million a year in revenue business, but the $500,000 business can make more money in profit. I see it time and time again. Just looking at people's numbers, I have access to a bunch of numbers through our consulting group. And there's people all over the board. There's guys who have $8 million companies that are 2% net. And there's a guy who's got a $7 million company with a 16% net and a $250,000 salary. And it's like, okay.
Yeah, so it's kind of about not getting so hung up and fixated on that top line, because it really doesn't matter.
Sorry.
They can be pulling in all kinds of money and not making any money. So something to keep in mind.
You get me back to my presentation, young presenters here. Sorry. Is there any other questions about P&L? So the biggest numbers you want to know is your gross profit and how you factor that in. Some people are putting sales in it. Some people are putting vehicles.
Oh, your computer is frozen.
There's no wrong or right answer. It's just staying consistent with how you do it, and then understanding net profit, what your profit is at the end. So if you're a small business, a sole prop, you should probably try to switch to an S Corp at some point, or a C Corp. Talk to your accountant. But again, what you have at the left, net, that is the most important number. And again, depreciation is going to lower it, but yeah, the more, you what?
Good for tax.
It is.
It's good for taxes, yeah. But you still want to, writing things off is key. So marginal indicators, things that are really important to understand is materials to revenue. So you want to understand those percentages. The reason you want to check that column, for instance, let's say, are you passing stuff out? Sorry. We'll get to pass that out. So understanding the materials to revenue is super important, because if your materials are out of control and you don't understand your numbers, how are you going to be profitable? If you want a 15% material and you have 23% and you check that at month 9, there's going to be no way to change that. And for an older company, you probably have a better understanding about numbers, but I've seen guys that have been in business 30 years who don't know what they're doing or don't understand their numbers. Some people are scared of their numbers. You should never be scared of them. You should always dive in. Direct labor to revenue. Oh, sorry. That's, let's say you have $100,000 and $30,000 goes out in direct labor. That's the labor to produce the revenue. That would be 30%. Cost of goods sold. Cost of goods sold is direct expense to produce the income. So that goes into paint, direct labor, payroll taxes, all the income or all the money it costs you to produce the labor. We have gross profit. Gross profit can be calculated in many different ways, which we've discussed. We have operating income, and we have net income. And again, understanding, net income is the single biggest thing. So if you have a 10% net at $100,000, that's 10%. But understanding these numbers, these are really key indicators. These are the single biggest indicators you need to understand. Is there any questions about any of that? No.
The difference between operating income and net income?
Why don't you explain for me, Liv?
So operating income is going to be, after all of your operating expenses, net income is going to also pull in the other income and expenses. So those are things that are peripheral to your business. So if you have interest income, dividend income, rental income, things that don't have to do with your main business activity are going to fall in there. That also includes other expenses. So we did talk about depreciation, taxes. I think it's fair to put taxes in there.
Some businesses have like a shop maybe, and they have shop income, maybe rent out half the shop or something like that.
Exactly. But it's not related to your main business activity, so that's why it's going to fall into that other income and expenses. So you can basically define the operating income as what you made from your main business activity.
So for some people, how long do those two numbers be the same?
Yeah.
Generally. Yeah, ours are pretty close.
Yeah, ours really only differ for the taxes. That's
Sure.
about it.
Yeah,
depreciation at the end of the year.
But some people, maybe you have a huge building that you own outright. You've been in business 30 years, and $5,000 a month is coming in income. That would fall under that category.
Should have that in an LLC and own it yourself.
You should, yes. So there's lots of ways to skin the pig. Talk to a CPA, attorney as you grow. Spend money to hire professionals. I surround myself with people that are way better than me at things because you got to understand. So, my wife I've been fortunate enough to have Lindsay open up my eyes to all this. So net income, that's what you got at the end. If you're depreciating a bunch of stuff, it's going to lower your net income. But you want to understand that number because that's the single most important number. 10%, $100,000 in revenue for the month. 10% means you made $10,000 in profit. That's what's left in the business after everything is paid, vehicles, all expenses. Let's talk about industry averages. These are compiled. This is just very rough. Again, everyone's industry or everyone's business is going to be different. For us here, materials to revenue, 14 to 17% for paint is generally what we see. We were at 10.5% last month. I think we're at 11 or 12 on the year. That's with sundries and paint included. We use Benjamin Moore paint, so, but Seattle's a higher end market, so we can get away with it. I've seen some new construction companies that are in the high 20s because it's all primer and paint, to blast the houses out, but then the labor percentages. Again, this is just industry average.
And kind of comparable companies to what we're doing.
Yeah.
So
I think
this is not the rule of law by any means.
Yeah, it's comparable.
But it's something that we've observed, and generally, if you fall in this range, we think
you're going to be
that's
profitable.
Successful.
If you're doing cabinets, you could be at like 7%, because there's more labor with cabinets. You buy 2 gallons of advanced paint or Pro Classic, and your guy's there for a week painting cabinets. Payroll to revenue generally is 30 to 40%. Granted, the lower you are in payroll burden, the better. Cost of goods sold, again, that is the direct expenses to produce the income. So that can be that can be paint and revenue combined. That's generally how we do it. Plus
paint and labor.
Yeah, paint and labor, thank you. Plus any expenses that are incurred with that, workman's comp, payroll taxes. Some companies put their sales rep into that. John's doing vehicles too, which is fine. You just have to understand the numbers and know it works for you.
Can you go over and show where these numbers are on the example?
Yes, Lindsay, help me out here.
Yes.
Sorry this stuff is so small, guys.
Size doesn't matter, you should know that.
Thanks, man. You'll,
All right, so I'm just going to focus on the accrual one.
And this is coming from someone who lives it every day, guys. We're doing the same thing. We're trying to all make money and put food on, our table.
Materials over revenue. that is going to be here. So for this company, that was 8%. If you're including your small tools and supplies, then it would have been 11%. Just depends how you're classifying that. Payroll, so talking strictly about labor, that's 30%. So it's falling right into here. And then cost of goods sold between 50 and 60%. So this is actually beating that by a bit. So that's great. And gross profit is 53%, and we had that at 40 to 50. So that's also pretty exceptional number for gross profit. Oh, net profit.
This is the most important number, guys.
Yeah.
How much money are you
I
making?
forgot the most important number. Net profit, 23%. Once again, really hit it out of the park compared to these numbers. Once again, it's not law. You can do better than this, you can do worse than this, and it depends on what you're doing too.
So again, I mean, we've seen numbers all over the board. I talked to a lot of painters. Some firms are huge commercial firms and maybe make 4%. Some guys make 20. I would say as a whole, I would shoot for 10% and above. As you're a smaller business, generally your net profit will be higher because your expenses are lower. Maybe you don't have a shop. When you start adding stuff, like in Seattle, a shop will probably add $3,000 a month to our overhead. So you start, in San Francisco where you're at, or you're in New Jersey, things are more expensive than maybe if you're in, Tulsa, Oklahoma or something. Sorry, guys. I'm just saying expenses are cheaper. Yeah, go ahead. Oh, okay. So, but net profit, I would shoot for 10% or above. If you're doing above 15%, you're killing it. Especially if you're taking a salary, 15% or higher is really, you're in the top 3% of painting companies, 2%. Again, some people are trying to lower their net profit on the books because they want to pay less in taxes, which is ideally a good idea to write off as much as you can. So if maybe you're at 13% and you write off a bunch of depreciation, it lowers you to 9%, that's fine. Talk to your accountant. But I would shoot for 10% or above. The smaller you are, the higher your net profit should be because you have less expenses. So,
what do you include for owner's salary, let's say $1 million business?
Probably $80,000 is what probably $80,000.
80?
That's what I would personally take. You want to pay yourself a livable wage, but I was talking to someone last night and they were saying how their friend was taking like $20,000.
Once again, I would always defer to your CPA for that because
we're not the CPA.
The IRS is the one that decides whether or not you took a reasonable salary for your position.
Yes, sir.
If you're an S corp. Yeah.
Okay, yeah. Yeah. Probably not.
Right. And I think the IRS feels that way too.
Yeah.
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 Exactly, and that's why, no matter what anyone says, you have to take it with a grain of salt because their margins might not even be including the owner's salary, which what we have here, that's assuming there's an owner's salary in there.
In that bottom line is with the owner's salary?
Yeah, it should be.
Yes.
I mean, you should be taking a salary. But again, you have to figure out, we're just teaching you guys numbers. We can't tell you structure. I mean, Lindsay and I both take a salary. We're an LLCS Corp, and we take the rest and pass through income.
That's not to say you do that from day one, because in my opinion, you really can't from day one. This is just kind of, I think, comparable businesses of our size that are paying owners on salary, this is kind of what we find the numbers to fall into.
Obviously, the more staff you have, too, the less your net profit is going to be. You have to figure out what works for you. Maybe you have a 6% net profit, but you have a $5 million company or $10 million company or $1 million, and you don't have to do anything. And that's, you're trading time or your money for time, which.
So it's no number is necessarily good or bad. If you're losing money, that's bad.
Yeah.
But if you have a low net, but you have the life you want, I think it's all about what Nick says, building the business for the life that you want to have.
Yeah.
So knowing your numbers, but not getting too hung up on comparing yourself to everybody else, because everybody wants something different.
Yeah. You got to do it.
You're saying is the owner's salary, what it should be, it could be a red flag for IRS.
Well, you talk to your accountant.
Yeah.
Let me share an example. So I have a buddy of mine who made $1 million last year. He only paid himself $50,000 a year as a salary. That triggered a IRS audit. So he called me all freaked out about shit. But He has two companies. He has stepped away from his first company, and he literally has handed it over to somebody else to manage. His other company has a secondary office. He has an office in the same unit. And so he's spending 95% of his time on his new business, trying to build that. And so he's, you know, so they came in and they audited him. I don't know if it's been a week with him or something. He passed. But, you know, the less, I mean, if you're going to ride the fence and you're going to really chance it, you're just putting yourself out there for an audit. And, you know, then there's fines. If you've lost, you had to, you know, pay a higher, calculated all that.
I mean, I've got myself up, but I just want to come up.
Keep in mind that here's the rule of thumb. You don't have to pay yourself the monthly salary. You have to pay yourself a reasonable salary. You should be drawing a little bit, but live below your means. This is what the PDCA standard is on this topic, is that you give yourself a reasonable salary. You want your net profit to be hopefully around 25% at the end of the year, and then you bonus yourself out to get the company down to about 10%. But within it, before the year closes, the IRS, it doesn't matter when you spend that money, it just has to happen within your fiscal year.
Sure.
Where that money is drawn out and you give yourself a reasonable salary. So if you wanted to, for example, you're $1 million company, you pay yourself 40 grand for the year, that's what you're taking monthly, but before the year closes, you bonus yourself an additional 50. That's still, they consider your salary now at 90, right? So just to put the make that.
A quick note, you know, again, I'm not a tax accountant at all, but the reason this stuff all matters, because when you pay yourself salary, you pay more taxes than when you pay yourself as an owner.
Yeah.
Yeah.
And that's why the IRS cares.
Yeah.
That's why when you hear somebody saying, like, you know, $20,000 on a $1 million business, you know, and that's like,
Yeah,
they're
it's,
trying to cheat.
You're only saving a little bit.
right.
Yeah, you're
The
missing
Social Security and Medicare,
so.
that's what they're worried about.
The other thing, I apologize.
No, go ahead.
No, you're fine.
You guys all have businesses. You guys all have good insight.
One thing that I was taught many years ago, the net income number is not, it's the return on investment that you're doing. So it's if you were to go out there and buy a company, as opposed to buying a job. Like when you're running your company, like you're the CEO of your company, the income, the salary that you're being paid is the payment for the actual job that you're doing. The net income is really the return you're getting on the investment of owning the business. So there is a significant difference. So if you pay yourself $20,000 and you're taking $200,000 in net profit, are you really going to be able to go out there in the world and buy a business for 20 or whatever $200,000 return or $200,000
Yeah.
return? So you got to really think of that as the salary is to replace, which somebody said.
Yeah.
Well
or
said.
what your job is worth.
Yeah.
And then the net income, which what Nick said, he now stepped away from that company. He's not getting a salary from the other company, but he's getting a hell of a great, net income on it.
Yeah.
Because it's an investment for him.
Sure.
So,
And again, yeah, I mean, there's several ways to skin the pig. I agree with you 100%. We know one guy who's got like a 30% net profit, a $1.1 million business. He pays himself $40,000 a year. There's no way that he could replace himself for $40,000 a year. He has killer numbers, but the guy, he does sales, he does everything, and he has like 10 painters. But understanding the numbers is the key, okay? It's talk to your accountant how you want to do it. We do it, we have an LLC Corp. We pay ourselves a salary, we take a livable wage, we take the rest in distributions, pass through income, it's taxed at a lot less of a rate than if we were all payroll.
And we don't do our own taxes. Taxes is a whole.
We hire a CPA.
different
We just do
animal.
Lindsay does our bookkeeping, but we hire professionals. We work with attorneys. Anything that's legal, you should hire. Pay the money.
Yeah.
My dad used to always try to shortchange stuff and do stuff himself, and then you're getting sued. Like if you're evicted, we just evicted a tenant in one of our properties. We paid an attorney. I paid her $2,200 yesterday. Not fun, but it's done right. The sheriff will come out on Monday and handle it. So do things right. It's just pay for professional services. When you're a younger business, it's hard, but you really get what you pay for. As far as structure, and really, we did that from the beginning. One thing she helped me with is structuring our business well, and we spent a lot of money the first 2 years. We had consulting firms, and this money and that money went out. I'm like, we're losing money. But we had a good structure, and that's why our growth has been good, and it's the right kind of growth because we have the right legal things set up so we don't get in trouble. So I'm going to pass it over to Lindsay, and she's going to talk to you guys about statement of cash flows.
All right. So we mentioned how your accrual basis profit and loss doesn't reflect your cash flow. So that's why this is relevant. Net income doesn't always reflect cash flow. So how do you see that? That is your statement of cash flows. And again, you can go into QuickBooks reports and look at this. It's going to calculate the inflow and outflow for every part of your business. So on the operating side, did cash go in or did cash go out at the end of the period you're looking at? The financing side, so your debt, as well as the investing side. So what it's going to do is reconcile the net income number to the actual cash inflow or outflow at the end of the period. So that's really helpful because you can actually see where that number came from. Now, it might be obvious, but let's talk about why this is going to differ. So let's say your net income was awesome, but your cash flow was not so amazing. So why would that happen? One reason is maybe you're not managing your receivables well. So as you become a larger business, you want to have a system in place for managing your receivables and not letting that get out of control. And once again, there's a QuickBooks report for that. We look at this all the time. Your accounts receivable aging detail report. You can take a look at who owes you money, when they owe you money, if they're past due, how old it is. So that's something you definitely want to keep an eye on, because I think that can get out of control pretty fast if you're doing a large volume of jobs. Debt payments. So something to remember is on your profit and loss, if you have any debt payments, a credit line, a credit card, auto loan, mortgage, the only thing actually hitting your profit and loss is the interest portion of that. So the principal portion, that's cash flow out, but it's not showing up on your profit and loss. So if you have heavy debt, that affects your cash flow for obvious reasons. And then investments. So if you made any large equipment purchases where you capitalize it right away, which means you put it on your balance sheet rather than writing it off as an expense, it's going to affect your cash flow but not show up on your profit and loss. This might also include distributions to the owner outside of payroll. So not your paycheck, but anything you might take out of the business throughout the period. And this also works in the inverse. You could have poor net income, but high cash flow if you did collect on a lot of old receivables, or if you've racked up some debt that you haven't paid off. Anyone have questions about statement of cash flows or comments? I didn't prep one. I could Google one.
We can show it at the end, right? No, if you want to show it now.
I didn't prep one.
Okay. Should have.
But yeah, we can find one and show one.
If you generate your statement of cash flows routinely?
Yeah, we'll look at it with the profit and loss statement.
We're looking at real-time numbers like
No, I understand.
weekly.
I mean,
Yeah.
We probably should, and I'll be honest with you, we don't. And I'm an ex-CPA, so I mean, we don't use it. We use balance sheet more
Oh,
than
okay.
we ever use a cash flow statement. So as long as we know that our
But it all comes from there, right?
It does.
So
It does.
you're still getting the same information in
That's
a
correct.
different way. I just think the statement of cash flow is a really easy way to look at it, especially if you're kind of intimidated by looking at a balance sheet. I think statement of cash flows is a really easy way to see that.
Probably the biggest thing with the statement of cash flows is it helps to show if you purchase large amounts of equipment,
Yeah,
because that does not show up on your P&L.
exactly.
Because you have to report that as depreciation. at the
Yeah,
end of the year.
yeah,
So,
exactly.
Because it's an asset, that cash, let's say that, your net income is showing $20,000. Well, you spent 25 on a piece of equipment, guess what? Your cash flow, your statement of cash flow is going to show that.
Exactly.
it's going to all show up in your payables. You move your monthly payments to short-term or your current payables versus long-term payables.
QuickBooks can help you as well. Not just having categories for your marketing, but tracking the vendors in QuickBooks, because you can pull a report to see how much I spent on this vendor, that vendor, so you can easily keep track of what you spent on any particular marketing source. So is everybody tracking ROI right now for each marketing source they purchase?
Nick is, yeah.
I knew you were. Okay. Well, let's just talk about the basics of it, the equation for calculating that. And we all talk about what is the best place to spend my marketing dollars. What's working for you? What's working for them? But it's like what somebody was saying earlier. I think it was Ron. Everyone is different. This is the only way you can know what's going to work. It's going to depend on your market. It's going to depend what your business is, and also just how you're utilizing these marketing sources. So to calculate it as a percentage, you take your sales growth that is attributable to that marketing source. So you should be tracking that in your CRM or whatever you have going on. And you take out whatever cost you spent on that marketing source, multiply it by 100, divide it by the marketing cost. That'll give you a percentage. We find it's often a lot easier to think about it as a multiplier. So for how much I put into this, how many times did I get it back? So that's a much simpler way to look at it. Your sales growth divided by the cost of that marketing source. I think anything over 10 times you can consider pretty good. Once you get less than that, less than 5, it's kind of a question of, was it really profitable once you think about your margins from every sale? So that's something to keep in mind.
What do you see, Nick, with Facebook?
So we just recalculated last year's a little off. Thought we were 15 or 19.
Okay.
2017, and we're now, this year, today we're about 22.
Okay. No, that's really good. That's good. We have some different metrics for different stuff, but but that's good.
Cool.
So would you say 10 times is good?
It depends on what you're getting. Like if you start tracking everything, so before I was getting really good returns on my marketing, when I was down, when my best one was like 9%, then really my cutoff was 4 times. So 4 times ROI means we were basically breaking even, but I assumed that if we're going to break even, we're probably going to get some referral work off it, so it made sense. But when I started to get returns that were 12, 15, 20, 40, then you kind of just go to the bottom of the list and you go, all right, we only want to spend this much money. I'm going to spend it on the things that are producing the best, right? And so that's what we did. So we've actually taken things off the list that we get 8 and 9 times ROI on.
Yeah, it's about decision making, not making those decisions blindly and having real data to back it up. So we're actually going to talk about a real example. This is actually from our business, Sound Painting Solutions, in the first quarter. So I know it's been mentioned a couple times, we do a lot of stuff on LinkedIn. So what we got out of LinkedIn, we got 16,000 to work just about. What I actually didn't include was some of the repeat work. We actually landed a pretty awesome vendor off of this, but I just included the first job that we got. So It was a little bit better than what's pictured here, but just for sake of illustration, $16,000. So when you calculate that out as a percent, it comes to 1,494%. I really think it's a lot more intuitive to just look at it as a multiplier. So for us, that was a 16 times ROI, which I would say was a success.
Last night we landed 3 more jobs from that client too, for 15,000 more. So that, yeah, it would be 30. Yeah, we just landed. I just got email last night. We were at dinner. 3 more jobs through a maintenance system. So yeah, it really is horrible.
Terrible.
LinkedIn's good to look at too, guys. It's if you know how to use it right, we could talk later. We use LinkedIn a lot.
This is why it's so important to track all this stuff. So
Yeah,
oh my gosh,
absolutely.
It's really good. Like if they didn't know that they're getting 16 or 30,000 or 30% ROI, they may just dabble in LinkedIn and just do it when it's convenient. But when they see the hard numbers, they go, holy shit, we're really producing some good stuff here. We got to focus on this.
Yeah, so let's talk about how to track that just on a practical basis. So I know Pipeline Deals is one CRM software that I'm pretty sure actually does this for you if you input all of the data as far as what you spend and then you're tracking per deal where it came from. So I would assume that some other CRMs have that capability as well. Does anybody know any other? Yeah.
I've used HubSpot. It doesn't. Householder social media now. I've got to check and see, but because mine is digital relationships, it's better for me to focus on that aspect.
Yeah, and even if you can't do it within your CRM, again, it's a pretty simple calculation. It just comes down to making sure that you're tracking where all of your leads, where all of your won jobs are coming from, so that at the end of whatever period you want to analyze, whether it's on a monthly basis, quarterly basis, or at the end of a marketing campaign you do, if it's for a set amount of time, like maybe if you're doing a boosted Facebook post, you just want to analyze it for that period of time. Whatever period you're looking at, just make sure that you're tracking it. And then it can be as simple as just having it on a spreadsheet, like a Google sheet. Just make sure you track it. Like for us right now, we have it on a smart sheet. So that's how we're tracking it. Plenty of ways to do it, and it's not too difficult. I think it all just comes down to tracking it. All right, and now Jeff is going to come back and talk about other key metrics that we have. I think we already passed this out, actually.
Yeah, does everyone have this out?
Early, but the key metrics.
Yeah, does everyone have it? That would
Yes.
be, yeah, key performing indicators, KPI. So good to know. I think some of this stuff John's software does too, right? All right, so John's going to help me with some of it.
Look forward to hearing about that.
Key metrics. Why do we do what we do? I mean, obviously we all want to provide a great place to work for our employees, you know, make the environment a better place, but it's about money. I mean, at the end of the day, if you don't have money in this society, you can't live. You know, if you want to give back, you have to have money to give back. So, I mean, unfortunately in this world, if you don't have money, you can't do the things you want to do. If that's donate money to an orphanage or you know, take care of your family. So understanding these key metrics is really important. Revenue per labor hour, that means maybe you bid a job at, you want $55 per labor hour and you bid it at 100 hours. Well, at the end of the job, you would need to understand what your revenue was per labor hour. How much were you making? So maybe it came in at 110% and it was, you know, $50 per labor hour. But that's a really key metric to understand is revenue per labor hour. Costs of goods, what was this one, Lindsay?
Oh, yeah, cost of goods sold. So it's just all of the things that branch out from the revenue per hour if you want to understand, you know, how every labor hour impacts that figure.
GP per labor hour, you can really get you can get really deep into it. Understanding your average sale, for instance. Very important too. I mean, if your team is closing $3,500 jobs, how many sales does your team need to sell? I mean, he's doing huge jobs. My average sale for interior is like 5,000. My average exterior is about 10,000. So understanding that metric tells me how many leads we need coming in a month, how many deals we need to close per month. Because again, if you don't understand those metrics, how do you keep your team busy? If you have, you know, we're not that big, but with 21 workers, it's an army, you know. You get 30,000 in interior work and it's gone in 3-4 days, you know. Understanding your closure ratio, again, that goes back. You can do that in a CRM. Does your system do closing ratio, John? Understanding closing ratio. Some companies have $100,000 contracts. Some companies like us, we do a lot of work. A couple weeks ago, we did 14 jobs in 1 week. So that tells me, understanding my closing ratio, how many jobs my sales guy, how many bids he needs to be doing. If he's closing 30%, how many leads does he need coming in per week? How many bids do we need to be doing to forecast to keep our feet on the street busy?
And if you have multiple guys, then it lets you know who can do a good job and who
Exactly.
Yep.
you need to invest in.
Exactly, but understanding your closing ratio. Maybe you have a sales guy who's at 50%, maybe you have one at 30. Seattle seems like a 30% closure rate market. There's guys out there that are killing it, selling $2+ million a year that I know, you know what I'm talking about. And he was like a 29 to 31% closure rate. Our jobs are pretty good size in Seattle, so you could have a lower closure rate and still close 150,000 in a month maybe, or 200 if you're a good sales rep. Closing ratio. Do you want to explain your current ratio and debt ratio?
Sure.
You what? Is there any questions about that? Okay. You can run that in like Pipeline Deals.
29%. close ratio, and he still sold 2 million, that's a lot of bidding.
Yeah, probably 25 bids a week.
30 a month.
You what?
That's 30 a month.
No, 25, that'd be 100 bids a month. 25 a week. My current new sales guy right now, he's doing 27 bids this week. His first full month out of training, he sold $131,000. So that's...
Does he have time to build rapport with the client?
He's killing it. He said he can do up to 25. This kid is a beast. I don't know. We're lucky to have him. He said 25 is his max, so he feels he can't build rapport, but he's getting it out, you know. I don't know.
Is he managing the jobs like Nick, or?
We do a different, our intake is our sales rep sells the job. So John and Nick do it similarly. The sales rep manages the job as a project manager. Our sales guy is selling, he passes the lead off and hands it off to our office staff, and we take over from there. There's no one size fits all. You have to do what works for you. I do similar, myself personally, I do kind of similar to what Nick's model is. And I sell and lead my jobs just because, you know, the owner wears multiple hats, so I still do that. And I still can sell $1 million a year and do a bunch of other tasks and no problem. But not everyone can do that, you know. For us, we found in our business, having somebody do one thing and focus on one thing only is best. If somebody's just selling, they should be able to sell more. Granted, if you're managing a project and selling, you're going to cap out because you have more follow-up to do with administrative stuff. So I would expect those project managers to sell less than if somebody's just selling. But you have to do what works for you. That's just, we found what works best for our model. But, you know, Nick and John both have great companies, and they do it as the project manager leads the job. And it also probably, like Nick was explaining to me, it cuts down on people forgetting things. So if you go to the office, I've heard this all the time, your sales rep gives it to you, or maybe you were telling me, both of you guys, and you hand it off, things get missed. So we have to make a lot of notes. My sales guy we make a lot of detailed notes in our estimate. So when the sales rep does get there, maybe it's the dogs that get loose. We've made a note of that. But if you don't have that, so if Nick's guy sells the job and runs the job, he can say, Mrs. Jones, you know, you can't leave the back gate open because their dog will get out. So there's a definitely, it's easier to manage things with the system they have from top to bottom, because the guy who's selling the job is doing the walkthrough and potentially leading the customer relationship and management. That's not us. Our sales guy sells, and then we handle it so things get lost in translation. So you have to figure out what works best for you. That's just what has worked for us. At some point it might change. I don't know. You just want redundancy with it, and you want to roll with it, and you want everyone on the same page. That's the key. You want to explain these things?
The other two that we decided to include were current ratio and debt ratio. So your current ratio is a liquidity ratio, your current assets by your current liabilities, and basically that's telling you how able your business is to pay off its current debts. So the higher that is, the better. If it's under 1, you might have a problem.
Yeah.
You have more debt. Your debt ratio is just showing how leveraged your business is. So your debt by your assets, and that number is the inverse. The lower, the better.
Yeah. Is there any questions about any of this? Okay. Yes, sir.
How do I find out how much should I charge? What's my labor rate? How do I figure that out at the end of the year?
Explain.
Next year?
How would you calculate it?
How would I calculate that?
That's a good question. Does your software do that?
No, you just take the simple way, like
Sure.
general. You take total production hours divided by total revenue.
Sure.
Right? And
Simple
then
way.
you come up with, hey, this is how much I need to charge
Yeah.
to hit that revenue.
The way,
For budgeting purposes, you need
Sure.
to know how much do I need to charge to hit this next year, or, you know,
Sure.
so on and so forth.
we generally track it per crew lead. We have our KPI. I mean, we do it more kind of per lead. Like we know exactly what each lead, what the revenue hour is per crew can produce. So on a whole, it's fine. We have crews that produce, you know, X amount. Like we have some crews that do custom work, and they're really slow, you know, and hours don't seem to mean anything to them. And then I have other guys that, you know, make us around $75 an hour. So we have one guy what does Scott produce an hour? 75 probably.
Probably, yeah.
Sometimes he's produced upwards of 300 per hour on some custom stain jobs. The guy's a beast. So we do it more, rather than a whole, we do it metric by crew, because we kind of know what to expect from each crew at the end of the year. And a lot of our crews have been with us long. You know, as a crew's been with you longer, you can project what each crew is going to produce for you. Like I have one crew's been with me 4 years, and I know he produced 440 3 years ago, 438 the next year, 447 the next year. It's always just within 10,000 every year. The guy's good for about 90,000 in profit, that one crew. So Final conclusion, we discussed our business. We went over chart of accounts, baseline for financial statements, which we can definitely touch down upon if you guys have more questions. Cash versus accrual. If you take anything away from this, we highly, highly recommend being on an accrual basis. It's a lot easier to understand. Cash base, I don't know. I pull everything in accrual. I don't even mess with, I keep QuickBooks easy for me because I'm only okay at this. Lindsay's the pro. I just want to know my numbers, my net profit, my gross profit, where we're at. What we need to do if materials are out of whack, what we need to do to change that. Statements of cash flow, that's important too. He looks at it from the balance sheet. I really like statements of cash flow. Yeah, maybe you made a large purchase, maybe $300,000 came in revenue, $50,000 in business profit came in, but you had quarterly taxes and a bunch of other stuff came in, and maybe you have negative, even though you have positive profit, maybe you have negative cash flow. So understanding statements of cash flow, however you're diving into that, is really important. I use that all the time. We just purchased a new vehicle, and at one point, I think we're positive finally, but we were a little negative. Our profit was positive for the year, but we actually lost cash flow between quarterly tax payments, bonus, I forget, a bunch of stuff. A bunch of stuff came out in January, a bunch of quarterly stuff. And so we were positive with net profit, but we were negative with cash flow. That doesn't mean we didn't have money, but we had to take money out of savings. Understanding marketing ROI, Lindsay can touch down upon that. Understanding KPIs, I think John's software, that's key performance indicators. Does it help you with that? Okay. Another big takeaway, if you don't have a QuickBooks Pro advisor or a bookkeeper, we highly recommend you can get these people, they're $50, $80 an hour, 30. They come in and they do your book data entry 2 or 3 times a month, depending upon your size. Lindsay does it all for us, so we're real fortunate. But having that done, how often does your person come in, or who does yours?
I'm sorry.
Who does your QuickBooks stuff, like entries?
I have a CFO. He's in our books every day. He does everything digitally.
Okay, but how many hours do you have him in a day? 2?
He doesn't do our stuff.
But what would you say he does it? 2 hours a day, hour a day?
No idea.
Okay. No, it's fine. What do you do, John? What are you doing for your QuickBooks?
I have an office manager who does all the daily stuff.
Okay.
Yeah.
AP, AR, and then
Okay.
I sub out to get a second pair of eyes on it to make sure my bookkeeper's not stealing from me.
Yeah, you always want to do
That's
outside
super
audits as you grow.
That's super
Monthly
important.
reconciliation I pay for, and then I have a third, my accountant does my annual.
Okay. Yeah, as you grow too, outside audits are good. People have cash control. I heard a horror story of about a $20 million painting company. Their CFO was stealing like $2,000 extra a paycheck for 7 years.
Yeah, and those of you that are a
so.
lot smaller, maybe it's not even a reality yet to have somebody in the office doing the books. But keep in mind, if you're a small business, you likely can't have those separation of duties, so you really have to protect that. Yeah.
One easy way that you can avoid that is making sure that you're the one issuing the checks. So while it's good to have certain checks and measures, but that is a way to help prevent that from happening.
Yeah, that right there is huge.
Yeah, I mean, having...
Careful of that, my buddy runs an auto shop, and he makes sure he signs all the checks, and then she just forges his signature on a few checks.
Well, they shouldn't have access. Nobody else should have access but you.
For me, what I do is I print all the checks. So by having that control,
Sure.
they
So yeah, I mean, that's like accounting. I mean, that's as you grow. But the biggest key is if you're small, get a QuickBooks Pro advisor, get someone who can do your books. If I didn't have Lindsay, I'd hire it out.
Yeah.
No, I mean, I really would. I wouldn't, I understand the numbers extremely well, but as far as that, I'd hire somebody. If you have a weakness, hire your weakness.
We sub all ours out.
Perfect.
Where, so I would get maybe another sub to check their work. Or what would you say to go about checking their work?
If someone's doing your QuickBooks and they're not controlling the actual cash and you're smaller, I think you're probably fine. But I don't know. I'm lucky to just have her. You should be
Yeah.
fine. If it would be
That's separation.
yeah, if they're auditing, then it would be auditing air. You would have your accountant at the end of the year maybe check it. He checks our books too to make sure everything's clean.
The other way I've also been
Sure.
told is go to electronic payments on everything.
Yeah.
Sure.
And then that way they can't necessarily forge your books at least in QuickBooks.
Yeah.
Changing once it's electronically been paid.
Everything's electronic.
We do a lot of ACH payment through QuickBooks. It's like a 50-cent fee or something. You wait 3 to 5 days, enter their bank account number, and the money flows. It's pretty awesome. So do you guys have any questions? I mean, that was kind of, yes, sir, go ahead.
So we don't use QuickBooks, everything's old school, I'm all about Excel spreadsheets, everything's pen and paper, she's always been our brother. I was talking to Michael a couple months ago about it, wanted to jump into it, but I have no clue where to start. Does that pro advisor, will they help you get it set up properly for your business? Or
Absolutely.
Sure.
Get that information?
Do you have an account already? Yes. Talk to them, start there.
Yeah.
And then, the biggest thing is you joint accounts to your pro-advisor.
Yeah, that's a baseline right there. But they can absolutely do that. And I was going to say, I don't think a lot of the day-to-day stuff is necessarily hard to learn. As a business owner, you probably just don't want to spend your time on that. But even if all you do is get someone to help you get it set up and get it set up properly and then kind of take it from there on the day-to-day stuff, at a minimum, do that if you're just starting out. And they can absolutely help with all of that.
And don't be afraid to run both programs parallel until you're comfortable.
Yeah.
Switch.
Yeah.
Because, I mean, nothing will mess you up more than thinking you got something figured out and starting out completely wrong. I mean, because I'm on a board for a nonprofit, and the accountant screwed up when we transitioned to QuickBooks.
Okay.
And it took us a year to unravel the mistakes that were made because accounts were set up wrong, things were
Yeah.
done wrong. It was just, she was just incompetent. We didn't find out until too late. And so we ended up in a situation where we're just unraveling, mistakes that were made at the foundation.
Who did you hire to do that?
We hired a new person locally that.
Oh, okay.
In our city to unravel that situation.
Sure.
Oh, okay.
But it was a mess because it was an internal hire. I mean, it was a hire to bring somebody to set up QuickBooks, and that's where she went wrong.
Sure.
They didn't do the advisor.
Yeah,
And
yeah.
that was probably the first mistake.
Yeah, personally, I wouldn't bring someone in as an employee. I would say find someone with a reputable firm that has those qualifications and certifications. I think that's your best bet.
I'll leave you with this. I mean, business is trial and error, okay? If you go to college, you figure it out. Listen to Nick's stories, $250,000 in debt. We've all had it. My first business, Lindsay probably would have divorced me if she saw my books. It was bad, man. I had no clue what I was doing. So you live and you learn. It's just really good to seek expert advice. I never got this because my dad would always try to save money like I discussed earlier. So
yeah, I think just don't be the guy with the shoebox at the end of the year and the stack of papers.
Yes, prepare yourself, and you're going to learn.
Nobody has to be that guy.
You're going to make mistakes. We've made a bunch of mistakes. So we'll leave you with that. Oh.